please give a warm welcome to Dino Mancini.
Thank you, Simon, and I'd like to also extend a sincere welcome to you all. It's good to be all together once again. It's incredible how time does go by quickly, though. So it's a year on from when we last spoke in an audience of this size. So we'll talk about the budget. Fortunately, this year it wasn't a budget that was filled with all the immense changes that we experienced last year, which we'll reiterate tonight. And it was a spectacle, wasn't it? So unlike what perhaps Simon thought, I was there ready and waiting, sitting down, telling my kids to be quiet, and I was focused, listening intently. But I did close my eyes, and it was quite reminiscent of another treasurer. I was listening, and if I didn't pay particular attention of whom the treasurer was in Scott Morrison, but just cast my mind back, it sounded like the echo of Wayne Swan. And I say that for good reason. We don't worry about the disclaimers. No advice here tonight, just general information. It was very Labor-esque. Now, you may disagree, but it was very, very Labor-esque. Spending on health, spending on education through Gonski 2.0, unless you're Catholic, of course. Spending on infrastructure, guaranteeing Medicare, guaranteeing the National Disability Insurance Scheme, bashing the banks, doing all things that I thought, surely this can't be a Liberal government. And yet, let alone it was. So the theme of this budget was more, rather than economic, more political. And it was really to try and drive some support for a lagging Malcolm Turnbull government. And I guess it's all the old adage of, if you can't beat them, you might as well join them. So they took a lot of the policies and they said, let's throw them out there and let's see whether anything sticks. Scott Morrison made a few little quips along the way. Quite interestingly, he talked about being responsible opportunities. I thought that was quite odd. He called on a song from Justin Timberlake, Cry Me a River. Do you remember that song about the banks? Cry me a river, we're going to tax you, we don't care. More so fairness, security and opportunity. And interestingly enough, which again goes contrary to what one otherwise would think of a coalition government, is we cannot agree with those who say there is nothing the government can do. So there's intervention that the government has sought fit to say, well, housing affordability, Medicare, National Disability Insurance Scheme, the government has sought fit to intervene. In terms of where the budget sits today, the big D word keeps year after year rolling on. Another deficit again. So we've had more than 10 years of deficits to boot. But I give them credit, they have started reducing the deficit. They are making inroads. So the current deficit does stand at $37.6 billion. And it is due to decrease over time to $29.4 billion next year. And hopefully we can envisage a surplus of $7.4 billion come the beginning of the next decade. Again, the proof will be in the pudding. They have made some very optimistic projections of where they think wages will be, where they think GDP growth will be. The italics optimistically projected is what I've inserted. Particularly in wages growth. Wages growth has been languishing in and around 1.5% for quite a number of years, pretty much since the GFC. And they're envisaging that it will double in the next two financial years. And I just can't see that happening, honestly, but we will wait and see. One thing that they did talk about, and I think to their credit, they're doing the right thing in trying to change the narrative in terms of what is actually good debt and what is actually bad debt. What you put in the different buckets is always contestable, but in terms of the infrastructure spend, they now have allocated over $70 billion towards a number of projects across the country, roads, rails, the upgrade of the dam in New South Wales, and they'll continue to do that all the way through to 2020-21. However, the caveat is always, and every single year we say this, is legislation has to be passed through the Senate. Okay? And we know that the Senate is a quagmire of independents, I won't call them anything other, whom make an interesting kaleidoscope of views and opinions. So we shall wait and see where things land. So just a key summary of the points we're going to touch on tonight. We're going to look at personal taxation, business taxation, superannuation, inclusive of the reiteration of the changes that were made last year. There have been some subtle changes, and that's by way of the Senate and all the amendments that have gone through just to get some of that legislation through. Thankfully, if you recall, the lifetime contribution limit of $500,000, that was ditched, thank goodness. But they have thrown in a number of other changes that are going to be, I guess, somewhat contentious over time. Retirement income stream, Centrelink, and a few other measures to boot. All right, so we started off last year. We'll start off once again. The temporary budget relief levy that was introduced all the way back in July 2014 will cease at the 30th of June 2017. It didn't affect many people. It was basically the excess. If you had more than $180,000 of taxable income, you would pay an additional 2%, so your marginal tax rate was 49%. So effectively that will be eliminated or abolished, and from 1 July the tax rate will drop for the highest income earners down to 47. So this is what Labor's arguing about. They're saying you're giving a tax cut to that group in society, and Labor's trying to argue that should be retained on an ongoing basis. I think it's probably best to try and reduce taxes across the board. So we'll wait and see where that sits. But so the tax rates won't change as they currently sit, other than for that temporary budget relief levy will be removed. In terms of increase in Medicare levy, the government has saw fit, and again, a take on probably the days of the Julia Gillard government, where they would increase the Medicare levy to fund the National Disability Insurance Scheme. They've chosen to increase it by 0.5%. So from 1 July 2019, Medicare will rise to 2.5% rather than the current 2% that we're currently paying. And in a way, that's probably good policy, because that will fully fund the insurance scheme on an ongoing basis. And I guess it's a way that we're all paying towards that, I guess, good thing for society and the community as a whole. All the, I guess, the thresholds that apply for Medicare, they will continue. So depending on how much income you earn in a given financial year, whether you're an individual couple, single with dependents, will determine whether you pay Medicare or not, and of course, by and by that increase from 1 July 2019. So as you can see there, the thresholds have slightly increased. For a lot of people in this room, Medicare is not something that we need to worry about too much, but it may be a factor in the years ahead. In terms of the low income tax offset, this was up for discussion leading into the budget. There was thought that they would actually remove it altogether. Fortunately, it hasn't been touched, so the low income offset does remain, and a lot of you do get that benefit by way of your taxable income. This one will impact on investment property owners. So the government has sought fit to no longer allow landlords to claim the travel expenses to and from their investment property for maintenance or collection of rent, where they personally do it. So they disallow that deduction altogether. If you use a third party in the way of a real estate agent, who must be rubbing their hands together at the moment, it is still deductible. So I suspect a lot of landlords may want to go onto that system where they engage a third party rather than do it themselves. So that's why they can continue to retain that deduction. Another interesting point that's going to, I guess, cause a little bit of angst as well. Typically what used to be in the past was if you bought an investment property, all the fixtures that were in that investment property, you as a new landowner could still claim the depreciation against those assets. Effective from 1 July, you will no longer be able to do that. So unless you yourself as the landlord purchase new fixtures or fittings, then you'll be able to depreciate them, but you won't necessarily be a benefactor of the previous landlord whom you bought the investment property from. So that will reduce the deductions associated with investment properties. So there are grandfathering provisions for those that have already existing investments at the moment, or investment properties. They will be able to continue to depreciate those items so long until the point in time which they are fully depreciated, or that they actually sell the investment property itself. From 1 January 2018, and there's subsequent implementation dates going forward, the government has sought fit to tax students and reap, I guess, the funds that have been allocated to universities from students a lot sooner than would otherwise be as currently is the case. So they're basically going to require students to contribute a greater amount towards the payment of their university fees whilst they're at university. And they're going to be doing that by a factor of 1.8% every year for the next several years, rising up to an overall increase of 7.5%. So for a lot of students, that's going to be a big rise in the cost of going to university. In terms of the thresholds, in terms of repayments once they've left university and they've started in the workforce, what currently is 10 different levels of income and percentage repayments, they're going to broaden that to around about 15, 16 different items. And I'll just show on the next table so you can appreciate that. As you can see there, the column on the far left there, or far right, my right, basically is the current thresholds and the percentages that students have to pay when they go into the workforce and earn that sort of income. The proposed changes from 1 July 2018, you can see they've inserted a lot of other percentages and they've lowered the thresholds. So a lot of students will be paying back more as they're going along. They also did talk about the fact that whether at death any outstanding liability would be payable to the Commonwealth. They haven't changed those laws just yet. So therefore that is a way out, probably not a pleasant way out of paying any entitlement or fees. In terms of business taxation, from 1 July, as I said, they're going to apply a levy of 0.06% against approved deposit institutions, which hold $100 billion worth of liabilities. So this is the big five bank tax, they call it. There's only 5 banks in the country that have $100 billion of liabilities on their balance sheets. So that effectively is the big 4 and Macquarie. Any other financial institution will not be impacted by this levy. The government's take on this is that it will encourage competition with the second or mid-tier players up against the banks. We know what the banks will do, won't we? They'll just pass it on. They'll pass it on. And they'll pass it on through reductions in deposits and their interest rates against those. They'll pass it on in perhaps tweaking the dividends, increasing mortgages, other fees on credit cards, other things to that effect. So invariably we'll end up paying it. So this is an impost that is directly impacted on the bank, so it comes out of their bottom line, their profits. It's unlike, if everyone remembers the financial institution deposits levy that used to be around, yeah. So that was actually a tax on deposits, on your own deposits. So it's a little bit similar, but there are some differences. So we'll wait to see. The banks are really fighting hard on this. They're taking the view a bit like the big miners did when the Rudd-Swan government wanted to bring in the mining tax. They want to try and see if they can force the government's hand and not get this over the line. Labor supports it in principle, but for some reason they're going on about, and even Xenophon's going on about wanting to tax foreign banks as well. I'm not too sure whether that's a wise move. So this will get up in some form or another, and we'll wait and see. Obviously, all those banks there in the mid-tier, Bendigo Bank, AMP, all the rest of them, they're cheering for this. They're saying, yeah, that's fine, pass on to them. We encourage customers to come to us. Wait and see whether that will impact greatly on the banks themselves and the underlying profits in the years ahead. In terms of small business, in terms of the asset write-offs, as of the 30th of June this year, it was envisaged that small businesses that acquired assets that they used in their business that were less than $20,000, they were able to write them off as an immediate write-off against their tax. The government has sought fit to extend that for another year. So businesses like ourselves, we gladly welcome this, as it gives us the opportunity to write off expenses for assets that we purchase within the business. After that date, so from 1 July 2018, it'll go back down to $1,000. Also, they've tried to close a few loopholes as well for some businesses. What's happened in the past, related entities were able to, I guess, exploit those loopholes and claim assets that weren't directly used in the business and the concessions associated with small business concessions. So the government's closed that loophole to basically say that businesses can only claim those assets which are directly used by that business and not related entities. Okay, so this has been a lot of conjecture about the company tax rate changes. We would have heard a lot about this. You know, what is the right size business, whether a business of 50 million deserves a tax cut and whether a business of 10 million deserves a tax cut. So you may have heard about the different variations, and the Treasurer made a plea to Xenophon about businesses like the Laura ice cream making in Golden North being denied a tax cut if they didn't pass it. So they basically came to an agreement that they would pass the tax cuts. So for businesses that are earning less than $25 million of aggregate turnover, they will get a tax cut as at 1 July 2017. And as you can see there, that will progressively increase to businesses with an aggregated turnover of less than 50 million. They will go onto that lower company tax rate. And that is envisaged for the next 10 years. The government from last year had envisaged that all companies would get a tax cut and they would eventually reduce the company tax rate down to 25 cents in the dollar. They are still committed to that and they still want to force that through, but the Senate is not budging or yielding. So at the moment we are faced with that sort of tiered approach in business taxation. So what does it mean for you as shareholders? You're going to get multiple different rates of imputation credits depending on the size of the companies that are paying the dividends to you. So what was previously an easy way of everyone's paying 30 cents and the imputation credit was effectively the 30 cents in the dollar, it could be 27 and a half, it could be 25, it could be 26, it will vary. Okay, it could even be 30. So it's interesting to see how that'll play out over the course of the next 10 years. And as I said, most other countries across the globe are looking to reduce their tax. You may have heard in the US, Trump envisages reducing the company tax rate down to 15 cents. So that's a pretty aggressive tax reduction. And look, we can't lay idle and not follow suit. We have to reduce our taxes if we're to remain competitive. For unincorporated small businesses, they also have a bit of a tweak to their tax concessions as well. So unincorporated businesses that have a turnover less than $5 million, their company tax rates will be applied at various different rates depending on the period in time. It is capped at $1,000, so it's not that valuable to some of those companies or entities, if you like, so partnerships or sole traders, but I guess every little bit helps. Moving on to superannuation. So this is where the government has sought to intervene in that housing affordability debate. They've basically allowed first home buyers to make contributions into their super, of which they can then take out at a future point in time to afford them to buy a new home. It's one of those things that I didn't think was going to get up, and it did though. Whether it's going to help, I'm not so sure. If everyone remembers the first home owners grant that used to be a few years ago, $7,000, we used to call that in the industry the first home sellers grant, because the sellers would just prop up the prices by an extra $7,000 and take it for themselves. So we're not too sure whether this is going to be inflationary and just keep fueling the flame of that housing affordability argument. But what it will enable young people to do is, if they've got the means to either salary sacrifice or contribute on a after-tax basis into their super account, there is a limit. They can only do $15,000 per year, up to a total of $30,000. If they're a couple, they can combine the two, so they've got $60,000 effectively. And then once they reach that level, they can take it out of the super system. It will get taxed at marginal tax rates, but they do get a 30% offset. Okay, so it'll be interesting to see how much take-up there will be. The Rudd-Swan government had a very similar scheme back in 09, 10, and it was a dismal failure. No one really took it up. So I guess the proof in the pudding will be how many people take this up over time and whether it's going to be of any good use. The other measure that they've introduced, interestingly enough, to encourage, I guess, additional supply and stock is encourage people to sell their homes, and particularly retirees, to say, if you want to sell your home, you'll be able to put that money into the super system, irrespective of you not fulfilling the work test over 65. So you can still contribute to super up to a maximum of $300,000 or $600,000 for a couple. So that's possibly something that could aid a number of people, but they have to sell their home and downsize, and that's not necessarily always an easy thing. It does go contrary to the government's wants for you to stay in your home longer for home care and other things to that effect, and also does go against the fact that yes, they might give you a benefit to put that money to super, but it will count as an asset towards the Centrelink Assets Test. All right, so I'm not too sure again whether a lot of people will take this up. There's another caveat that you must have at least 10 years residing in that home as your main residence. Again, proof will be in the pudding to try and see how many people will opt to downsize and sell their homes. Okay, the other main slides, there's about 5 or 6 slides, is a recap of all the changes from last year that will take effect from 1 July. Hopefully, we've seen pretty much most of you to familiarise yourselves with these changes and how they will impact on you. We are going through still quite a number of clients and we'll be contacting you regarding some of the more peculiar cases that need to be dealt with before 1 July, and I'll get to that in a moment. But let's start off with something very simple in terms of how much you can contribute to super. So this is where that lifetime contribution cap of $500,000 was thrown out the window, and the government found its common sense to say, okay, let's look at a system where we can perhaps get what we want, but in a way that's not going to disrupt the superannuation system. So as things stand, the current rules are that you can contribute $180,000 a year or up to $540,000, bring forward 3 years' worth of contributions. So that is applicable to 30th of June, so if you've got a spare amount of money and you've still got ability to contribute and you've got a gap to meet the maximum cap, we encourage you to do so. From 1 July, that cap will be reduced to $100,000 on an annualised basis or $300,000 on a 3-year bring forward basis. However, the issue of concern is this what's called special transitional rules, because on the top of that, they've overlaid a $1.6 million cap. So if you've got $1.6 million or more, you can't contribute to super. And if you've got 1.4 or 1.5, you'll also be limited in how much you can contribute on a bring forward basis. So there's a few complexities that don't exist at the moment that will take effect from 1 July. So we will have to watch this closely, and the other thing of note is the ATO will be the custodian of all this information, and we know how good the ATO is at times, so they're probably marginally better than Centrelink, if anyone's dealt with Centrelink, but the custodians of this information will be contacting ATO quite often to find out where things sit for clients, maybe not so much for yourselves, but definitely for new clients, because from 1 July, everyone will have a new figure that has to be accounted for. And this is where it comes into. So you've got to have less than $1.6 million to be able to contribute, and as at 1 July, everyone's superannuation balance will be determined whether you can contribute or not. Now that 1.6 million, people think, oh well, I got nowhere near that much, but it's actually the combination of both your retirement income stream and your superannuation. So it's the total holdings in the superannuation system. So for some people who they might have an allocated pension that they've done and then they go back to work and they've accumulated a bit of super, they might find that they can't contribute any further because they're going to reach that cap. And that cap works on a debits and credits basis. So it's something that's not just, I'll never get close to it. You've got to be mindful it's year in, year out. In terms of concessional contributions, so pre-tax contributions, they are reducing the cap. So currently as it sits, if you're under 50, you can contribute up to $30,000 per annum. If you're between 50 and 65, $35,000 per annum. If you're over 65 or over, so long as you fulfil the work test, you're also able to salary sacrifice or contribute $35,000, claim a tax deduction. From 1 July 2017, it will be, regardless of age, $25,000 across the board. That $25,000 does incorporate super guarantee. So it's not just about your salary sacrifice, you have to factor in what your employer's putting in as well and work out the difference. For those that are in state government, the existing unfunded schemes or untaxed schemes are not subject to this, so long as you do not contribute into a taxed super fund or you don't do a second job where you're receiving super guarantees, because if that happens, then they'll count all of it, and then we could have a big problem. So there are some nasty stings in the tail in terms of if you do something that you think shouldn't be a problem, it could get you into a lot of bother in terms of tax. Last year we were jumping up and down with glee because they were going to remove the work test. And we thought, wow, this is fantastic. Many of you could contribute into super and don't have to worry about finding a position of employment and fulfilling that 40 hours and 30 consecutive days in a financial year. For some reason or another, government came to their senses and realised, geez, this is a big tax hole in the budget, we better reinstate that, and they did. So the work test remains, so that anyone from 65 years onwards has to fulfil that work test and that criteria, and it needs to be a position of eligible employment. In regards to spouse contributions as well, it can be made up to age 70, and beyond that it can't be. The one thing regarding restrictions on tax deductible contributions, they have removed that restriction. So currently as things sit, you either have to be self-employed to be able to claim a tax deduction, or what's called an unsupported person. And there's a whole number of rules associated with that. And particularly what's called the 10% rule. That fortunately will be removed from 1 July, and so from 1 July anyone can contribute to super and claim a tax deduction. Again, so long as you meet the work test if you're over 65. So this is something perhaps that will enable a lot of people to make up catch-up contributions or perhaps minimise their tax in a point in time when they're selling down assets. The low income tax offsets also will be retained, and that's for anyone that's earning under $37,000 of taxable income. The contributions tax that's typically payable on contributions made on your behalf by your employer, the government will reimburse your super fund, so that anyone under $37,000 effectively is paying no contributions tax at all. They've also made some changes to the spouse superannuation and contributions tax offsets, which kick off from 1 July 2017. So at the moment, as we said last year, if a spouse earns less than $13,800 and you contribute up to $3,000, you'll get a part offset. They've chosen to increase that lower threshold up to $37,000 of taxable income, up to a maximum of $40,000. So this will help a lot of you actually. So if we start talking about spouse contributions, to get a $540 benefit on your tax, it's a good little strategy. And it's not much, but 540 of 3,000 represents an 18% return. Okay? And an 18% return is pretty good in this low growth environment. And if you can get it by just moving money around, why not? In terms of they've reduced the threshold which the additional 15% contributions tax applies to. So previously, for anyone earning over $300,000, they were paying 30% on contributions tax. They've reduced that down to $250,000 that you start paying that additional tax. It doesn't impact on many people that we're aware of, but for those that are earning that sort of income, it will. The other interesting point was the catch-up contributions, so the catch-up of concessional contributions. This is effective from 1 July. So basically this will enable you to make contributions into super, so salary sacrifice, and if you haven't used up that cap of $25,000, you can carry forward the difference that's been unused, and you can carry forward the difference for up to 5 years. So effectively you could have a person that's not contributed anything towards that $25,000 cap themselves. They've got their super guarantee, so the difference might be $15,000. They do that for 5 years. They can then contribute up to $77,000 and effectively minimise their tax by claiming a tax deduction. So this is going to be a good strategy for those people that maybe have investment properties or assets that they wish to sell. They've got a capital gains tax problem. We'll look at whether there's concessional caps that haven't been used, and then we will encourage you to put those proceeds of sale as a concessional contribution and then reduce and offset the capital gain applicable. So this will be a strategy that we might, you might be able to utilise going forward. This one here is one of those payments that if you were to pass away, the super fund would contribute back all that tax that was paid over the course of the accumulation of that super. From 1 July that will be abolished. So if anyone plans to die, make sure you do it before 30th of June. In terms of the government co-contributions, by way of all these changes, there's two new means of testing whether you're eligible. First, the you can't exceed the 1.6 million cap for non-concessional contributions to get a government co-contribution, and they always look at the 30th of June balance of the year prior to determine whether your total superannuation balance is within that cap. So there's a couple of extra things we have to look for to see if you're entitled to an extra $500 by way of contributing $1,000 into your super fund. Okay, some busy slides, and this is probably one of the most important slides, and this is going to be impacting a few people, particularly if you're a defined benefit scheme member. So that'd be a Super SA pension member or an EISS pension member. So this 1.6 million transfer cap, so this is a different 1.6 cap to the one I've just spoken about. This refers to you transferring your money that you've accumulated in superannuation into an allocated pension or retirement income stream. So they'll only allow you to transfer up to $1.6 million, and you can't transfer anything more than that. For those that have got retirement income streams as at 30th of June this year above 1.6 million, they'll have to roll that back into super or take it out of the super system altogether. So there's a few things that we're doing with a number of clients to make sure that they don't breach the rules and get a nasty tax bill in the post. But the one thing of controversy is for defined benefit scheme members. So defined benefit scheme members is a little bit more technical. Your pension is multiplied by a factor of 16, and that'll determine your total super balance or your transfer balance cap. And if your transfer balance cap or your pension multiplied by 16 is equal to or greater than 1.6 million, that means that you're going to have additional tax on that pension. And if you have allocated pensions or retirement income streams, you're going to have to take them out, and potentially all of it. So you may not be able to keep that in the super system altogether. Now, I've gone through my client list, and I'll be calling a number of clients that will be impacted by this, and we will need to restructure your affairs. And for what gain, I'm not too sure, because for the majority of you, the good news is you won't pay any additional tax on that money, other than the actual pension themselves, but we will need to make changes. In terms of self-managed super funds, there is a provision there in terms of transferring money back into accumulation. You may have assets that are held in the self-managed super fund that you have to potentially realise, and that's been forced upon you by the changes to legislation. The government has sought to say, well, look, we're going to relieve or remedy the impact that we've made on that legislation so that you're not subject to capital gains tax inadvertently. And so people can elect to have what's called CGT relief, but they need to exercise that option. It's a voluntary exercising of that option. You're not obligated to do so. If you don't exercise the option to take that CGT relief, then it will be assumed that the asset is disposed of when transferred, and capital gains tax will be applicable. So I suggest that anyone's got self-managed super fund that's going to breach those caps, and fortunately for the majority of our clients, they don't, but for those that do, come and speak to us and we'll work hand in hand with your accountant to determine which assets are going to be transferred back so that we can minimise the tax and also perhaps opt for that CGT relief. Anyone with a transition to retirement income stream, from 1 July, the earnings on that pension will now be subject to tax. So currently, if someone's got a transition to retirement income stream, they don't pay any tax on the earnings. And if they're over 60, they don't pay any tax on the income they receive either. So there's a very, very tax-effective vehicle. However, the government has said we're going to stop this because a lot of people are still working full-time. It wasn't the intention of the legislation to encourage people to use TTRs for tax avoidance or tax minimisation. So they basically said we no longer treat a transition to retirement as a pension or retirement pension. It will be subject to tax on the earnings. The other thing also of note, which is quite of interest, previously you also had the election to say any additional income you took, you could treat that as a lump sum if you were able to take it as a lump sum. You no longer will have that choice. It must be treated as income from 1 July. Okay, on to Centrelink. So not too many changes in Centrelink that are going to impact directly on the majority of you. This is a good news story. A lot of people inadvertently lost the pensioner concession card by way of the changes to the assets test as at 1 January this year. the government has sought fit to reinstate those people with the pensioner concession card. So for anyone that has lost that card, you will automatically get it reinstated. I've just put up that table there of the thresholds that took effect from 1 January. And so if you exceeded those thresholds, you would lose the age pension and therefore, by way of such, lose the pensioner concession card. So good news there, you'll be reinstated, so expect a letter from Centrelink in 6 months' time, potentially, saying that you get your pension concession card back. And I say that without joking too much, because they're literally 4 months behind all the applications that have been going in. A number of other changes as well. The government has sought fit to give off a one-off energy assistance payment to a number of recipients of a variety of different Centrelink payments. So it's not just the age pension. So there'll be some one-off payments on the 20th of June this year as by way of the energy assistance payment. They've made some other changes to New Start allowance and sickness allowance. So from 1 July 2018, those terms will be replaced by what's called a job seeker payment, and there'll be a whole number of new conditions which are quite strenuous. I don't know if you heard about, there'll be potentially drug testing and other bits and pieces to determine whether you're eligible for an entitlement for being unemployed and seeking a job. Changes to family tax benefit payment rates, nothing to note there though, but they're making some tweaks there as well. Working age pension reforms, so a whole number of different allowances, particularly widows, bereavement, partner allowances. They will cease new applicants in the years ahead, and they will close those pensions or entitlements altogether at the turn of the next decade. So those payments will no longer exist. They've also chosen to increase the liquid assets waiting period. So this refers to people that are applying for allowances or New Start allowance. If you've got a bit of cash sitting in a bank, they're extending the number of weeks that it will take for you to get an entitlement from 13 to 26 weeks. And they're also changing the thresholds, $18,000 for singles without dependents or $36,000 for couples. So you really can't have much to get an entitlement, basically, and you have to wait a lot longer as well, up to 6 months. Some other measures that were made, changes to the financial regulations and dispute system. So this is something that will remove the financial ombudsman, insurance ombudsman, the superannuation complaints tribunal, whole number of different structures that we've become accustomed to in our industry are all going to be by the by, and they're going to replace it with one entity, which from a consumer perspective is probably a good thing, so that you've only got one, port to make and lodge your complaint rather than multiple different entities, and you don't know which entity to pursue first. They're also going to apply GST on bitcoins and other digital currency going forward, so that'll be interesting to see how that works and how they collect that. In terms of new residential premises, a lot of developers weren't passing on the GST to the ATO. They were going bankrupt, and then they were reinventing themselves as Phoenix companies and starting all over again. So they've sought to stop and close that loophole. Effectively, the GST responsibility, the onus of that will be on the purchaser of that new premise. So a lot of would-be buyers that think they don't have to remit GST will be obligated to do so in future. They've made a few number of changes in the next 3 dot points for foreigners and limitations on how much they can own in new developments, how much they get taxed, also an annual charge if a property is not occupied. There's a lot of property, particularly on the eastern seaboard, where it's been sold to foreign investors and no one occupies it. They're left untenanted, unoccupied, and the government's getting nothing out of that. So they've chosen to impose a charge against that. And they've also increased the CGT discount for investments on affordable housing. So currently it's a 50% discount on those investments. They're increasing it to 60% should you decide to invest in an affordable housing for rental. So they're the main changes that I think are going to impact greatly on you. Of course, there's other changes, but they are not necessarily of much interest to the audience that we've got and our clients. So it wasn't a budget that was of great note, other than for the fact that I'll reiterate all those reminders that we keep working through between now and 1 July and over the course of the next couple of months to make sure that everyone has got the right structures, so you don't get a nasty letter from the ATO saying you owe us such.